Wyckoff's true genius wasn't just drawing supply and demand lines, it was documenting collective human weakness. He was charting fear. He was charting greed. The charts themselves are nothing more than a historical record of mass psychological movement. You look at a Phase C spring and you see price action, but what you should be seeing is the collective moment of panic and subsequent capitulation. The market isn't testing support, it's testing you. It's testing your conviction, your patience, and your willingness to hold steady when the crowd is running for the exit. This is why you can memorize every accumulation schematic, every distribution pattern, and still lose money. The knowledge is mechanical, but the application is deeply, brutally emotional. This is the Wyckoff paradox. You are attempting to apply a rigid mechanical framework, strict rules of entry, exit, and volume analysis, to a reality that is fundamentally fluid, chaotic, and driven by raw emotion. You are trying to use a ruler to measure a hurricane. The market doesn't care about your textbook definition of Phase D. It only cares about who breaks first. And the one who never breaks, the one who remains perfectly disciplined, perfectly patient, is the entity Wyckoff called the composite man. The composite man is not some shadowy figure in a boardroom. He is the idealized trader you must become. He is the embodiment of perfect alignment. You are trading against yourself. If the composite man is your goal, then your greatest obstacle is the invisible enemy. This enemy is not the Fed, it is not the hedge funds, and it is certainly not the chart pattern that failed today. The invisible enemy is the gap between what you know you should do and what you emotionally can do. It is the lack of internal alignment between your analytical mind and your emotional operating system. You have the map, but your car keeps driving off the road. When you fail to wait for the spring, when you chase the breakout, when you cut winners short, that is the invisible enemy manifesting. It is the ego demanding immediate gratification. It is the fear demanding safety now. It is the reason Wyckoff's schematics are often called predictive, but rarely profitable for the amateur. They show you what the disciplined trader does. They do not show you how to acquire that discipline. To defeat this enemy, you must stop searching for the perfect strategy and start searching for the perfect self. And that search begins not on the chart, but in the quiet, uncomfortable truth of your own trading journal. That journal holds the key to the 4 fatal psychological traps that ruin 90% of traders. Those traps are not technical, they are entirely psychological. You are an intermediate trader. You know the mechanics. You can identify accumulation and distribution. You have read Wyckoff's principles. You can draw supply and demand zones with precision. You have a 70% profitable strategy on paper. So why does your P and L look like a flatline earthquake? Because the moment the setup appears, the perfect mechanics you learned instantly dissolve into imperfect, fear-driven execution. The chart tells you to wait for the spring, the shakeout, the final test of support. But what do? You enter early, during the volatile, messy chop of Phase B, driven by the panic that the train is leaving without you. This is the failure of pure mechanical analysis. The system tells you when to trade, your fear tells you how to trade, and fear always dictates the wrong price. The market is not fighting you, but it is certainly reflecting you. It is a perfect, unflinching mirror of your internal state. If you are inconsistent, the market will deliver inconsistent results. If you are impatient, the market will punish your early entries with maximum efficiency. Now consider the composite man. Richard Wyckoff's powerful concept of the ideal operator. The composite man is not some genius with a secret algorithm. He is merely the embodiment of perfect patience. He does not rush Phase B. He does not panic when the test occurs. He waits through the entire absorption process, allowing the weak hands to surrender their shares, only executing when the market has shown its true intentions. The composite man understands that execution is not a technical act, it is a psychological one. He is not emotional. He is not inconsistent. He is the operator you must become. But you cannot simply decide to become him. You must first excise the weaknesses that separate you from his discipline. You cannot pray away your impulsivity. You must dissect it. You're not fighting institutions. You're fighting the version of yourself who keeps moving the stop-loss, who keeps chasing the candle, and who keeps violating the journal rules you wrote just hours before. The market rewards the disciplined composite mind and systematically destroys the disorganized emotional one. The real gap between you and consistent profitability is not in your indicators, but in your ability to sit still when patience is required and to strike without hesitation when clarity is achieved. To close that gap, we have to look deeper into the engine of failure. We have to understand the specific psychological traps that turn perfect setups into devastating losses, not once, but repeatedly. These 4 traps are what define the 90%. They are the silent assassins of capital. Wyckoff's 3 fundamental laws are not just market mechanics. They are the blueprints for your internal state, and they reveal why you self-sabotage. The first law: supply and demand. In the market, it determines price action. In your mind, it determines survival. Psychological supply is the desire for instant gratification, the impulse to hit the button now because you fear missing out. This is the supply of emotional capital you are willing to burn. Psychological demand is your capacity for patience, your willingness to wait for the highest probability edge, and your commitment to your defined risk profile. When the supply of impulsive greed outweighs the demand for structured discipline, your account moves into contraction. You are trading your fear, not your plan. You are demanding immediate profit, and the market is supplying immediate loss. This is a fundamental imbalance that no technical indicator can fix. It is a misalignment of desire and discipline, and it is why you chase trades that never materialize. The second law: cause and effect. The market teaches us that accumulation, the cause, leads to markup, the effect. What is the cause in your trading? It is your process. It is the routine you follow before the market opens, the checklist you adhere to, the risk you define before entry. The effect is the P&L. But most traders focus exclusively on the effect. They stare at the green or red number, trying to manipulate the outcome without fixing the input. This is the trap of the intermediate trader, believing that intense focus on the result will somehow fix the flawed process. You cannot negotiate with the market by staring harder at the screen. If your cause is sloppy, if your entries are arbitrary, your stops are emotional, and your journaling is non-existent, your effect will be random. Stop chasing the symptom. Fix the disease. You must become obsessed with the quality of your input, not the magnitude of your output. The third law: effort versus result. In market terms, high volume, the effort that yields little price movement, the result signals absorption or weakness. Psychologically, this is the law of desperation. You are putting in monumental effort, sitting at the screen for 12 hours taking every single setup, revenge trading, but getting minimal or negative results. This effort is not quality effort. It is frantic, compensatory behavior driven by the fear of inadequacy. You are trying to force a result that your current skill set cannot deliver. The market rewards precision, not persistence applied blindly. Ask yourself, are you confusing screen time with mastery? Are you measuring the quantity of your struggle or the quality of your execution? The vast majority of struggling traders proudly measure their effort by the hours they sacrifice. But effort that is not aligned with discipline is just noise. It is just exhaustion masquerading as commitment. And until you pivot your measurement system, until you stop valuing the struggle and start valuing the structure, you will continue to pay the market tuition. To stop paying that tuition, you need the foundational structure Wyckoff spent 33 years building. If you are serious about moving from amateur to professional, you need the original playbook. Richard D. Wyckoff's How I Trade and Invest in Stocks and Bonds is that playbook. Wyckoff, who founded the Magazine of Wall Street, spent decades observing the biggest operators, the Morgans, the Harrimans, the Rockefellers, and codified their actions into the principles of accumulation and distribution. This adapted 2025 edition, edited by Max Davidson, provides the historical context you need to understand modern price action. Learn the absolute limitation of risk, the difference between speculation and gambling, and the methods Wyckoff developed from his early work in tape reading. Crucially, he details how to identify the fraudulent bucket shops that preyed on uninformed traders, emphasizing that sound investing relies on common sense, dedicated study, and practical experience. Stop guessing and start applying the methods evolved during Wyckoff's 33 years' experience in Wall Street. The link is in the description and below. With that foundation in place, we have to move past the simple emotional definitions of fear and greed. We need to define the specific actions that undermine your edge. That means understanding the 4 distinct psychological stages of a losing trade and how to interrupt the pattern before it steals your capital. The market doesn't just test price levels, it tests your internal resolve. Think about the Wyckoff schematics, specifically the shakeout or the spring. On a chart, this is simply the final purge of supply before the markup begins. But what is it doing to you? It's a deliberate psychological trap. It's the moment the market engineers fear just deep enough to make you doubt the structure you spent hours analyzing. Your plan is sound, but the sudden violent move down triggers the oldest panic. I must be wrong. This is fear overriding structure. It's the surrender of your conviction not to external forces, but to the immediate visceral pain of drawdown. You feel that pressure, that tightness in your chest, and the moment you exit, the move you predicted starts without you. The market has taken your capital and your confidence in one swift motion. If the spring is the trap of fear, the upthrust is the trap of desperate greed. The upthrust is that fleeting moment where the price screams past resistance, confirming your deepest hope that you haven't missed it. This is FOMO translated into action. You chase the move, abandoning your entry criteria, convinced that this time the breakout is real. Why? Because your ego desperately needs to participate. It needs to prove it was right all along, even if the timing is terrible. This chasing behavior is the fundamental difference between the mechanical trader and the emotional gambler. The mechanical trader operates on a flat emotional line, executing the plan regardless of the noise. They see the shakeout as an opportunity to confirm conviction, and the upthrust as a liquidity grab to be faded or ignored. Look at the classic emotional curve of a typical trade. Hope at entry, thrill at profit, anxiety during drawdown, denial when the stop is hit, and panic when the loss becomes enormous. That parabolic roller coaster is the price of emotional trading. Discipline, on the other hand, is the flat line. It's the quiet acceptance that you are not the market, and the market owes you nothing. Your ego demands correctness. It screams that taking a small, structured loss means admitting failure. But the market doesn't care about your ego's demands. It only cares about capital preservation. When you refuse to take that small, structured loss, you are not protecting your account. You are protecting a flawed self-image. You are sacrificing capital at the altar of being right. This need to be right is the greatest hidden cost in trading. It's what keeps you holding on to a dead position long after the structure has failed. But what happens when that hope turns into something far more toxic? What is the specific psychological structure that keeps you locked in denial, waiting for the miracle reversal that never comes? That specific structure is what I call the hidden stage. You're no longer a beginner. You understand support, resistance, order flow. You have a system that works. Mathematically, you have the technical skills of a professional, but the emotional fragility of an amateur. You've replaced the pain of ignorance with the pain of self-sabotage. In this stage, your P&L is defined not by the quality of your entry, but by the quality of your psychological resilience. You are technically ready, but psychologically unabsorbed. Emotional absorption is the capacity to watch a trade move 5 or 10 points against you, the expected adverse excursion, and feel nothing more than mild curiosity. It is the ability to maintain the plan, even when the market is screaming at your lizard brain to panic. Technical risk is the known quantity, the distance from entry to your stop loss. It is fixed and quantifiable. Psychological risk, however, is the variable. It's the moment you move your stop loss because you feel the market owes you a reversal. It's the risk that when fear hits, you will betray your own strategy. This gap between technical risk and psychological execution is where fortunes are lost. And ironically, the greatest trigger for this failure is not a loss, but a string of wins. The market grants you 3 or 4 perfect trades. Your ego inflates. You become loose. That discipline you fought so hard for vanishes the moment you think you've mastered the game. This overconfidence is the most insidious form of psychological risk. It convinces you that the rules apply to everyone else, but not to the new, brilliant version of yourself. You start taking larger size, ignoring the structure, chasing volatility. And when the inevitable loss comes, it hits twice as hard. It doesn't just remove capital, it installs doubt. The result? You shrink your size, you hesitate on the next setup, and you miss the perfect trade. This cycle, overconfidence leading to sloppiness, leading to fear, leading to hesitation, is the definition of self-sabotage. Consistency is not about winning every day. Consistency is the perfect execution of your strategy, regardless of whether the immediate P and L is green or red. It is the refusal to allow external noise to corrupt internal integrity. If your execution is perfect, the outcome is irrelevant. The market is simply providing feedback on your edge. But how do you build that emotional fortress? How do you train your mind to stop reacting and start observing? The answer lies in understanding the core psychological law that governs all financial markets, the law of effort versus result. The composite man is the embodiment of that law. He is the institutional mind, the relentless force of capital that operates without ego. He does not trade based on hope, fear, or revenge. He is impersonal. Your primary psychological task is to cease being you, the reactive emotional trader, and to start modeling him. To achieve this detachment, you must fundamentally change your expectation of what trading should feel like. If trading feels exciting, you are gambling. If it feels mundane, repeatable, and slightly boring, you are executing an edge. Excitement is simply the emotional tax you pay for lack of preparation. We are building a fortress of routine, designed to shut down the impulsive brain that ruins performance. This is where the practical tools of impersonality come into play. It begins with the execution checklist, not a complex system of indicators, but a simple, rigid list of criteria that, if not met, means no trade is possible. This removes the subjective decision-making at the moment of pressure. But the most potent tool is the pre-mortem. Before you hit the entry button, ask yourself, how will this trade fail? What emotional state will I be in when I break my rule? By anticipating the psychological pitfalls, you inoculate yourself against the surprise and regret that typically triggers impulsive responses. This shifts your focus from predicting the market's movement to controlling your own behavior, which is the only variable you can actually manage. You must stop auditing your P&L and start auditing your integrity. The trading journal is not a scorebook for profits and losses. That is the result, the effect. Your journal must be a deep psychological audit of the cause. You should be tracking 2 things above all else: your emotional state immediately before and during the trade, and your adherence to your rules. Did I trade out of boredom? Was I seeking validation? Did I chase the move because I felt left behind? These are the questions of the impersonal trader. The moment you start tracking why you entered a trade, not just what the entry criteria were, you begin to sever the emotional link to the outcome. When trading becomes predictable, when the execution is simply the next step in a mechanical process you designed while calm, you have achieved the composite man mindset. This process must be boring for the results to be consistently exciting. But even when you master impersonality, there is one final subtle psychological trap waiting for the intermediate trader. It is the silent killer of consistency, and it masquerades as discipline. It is the concept of perceived risk versus actual risk, and it is the key to unlocking the final stage of market mastery. The intermediate trader is addicted to control. You analyze the Wyckoff schematic perfectly. You identify the spring, the sign of weakness, the LPS. You know exactly what should happen. But when the market hesitates, when it throws a curveball just before the expected markup, you intervene. You tighten the stop, you cut the winner short, you abandon the structure because your perceived risk, the anxiety in your stomach, overrides the actual risk defined by your entry and stop loss. This is the first betrayal. The paradox is this. You gain control over your trading results only when you fundamentally surrender control over the immediate market outcome. You are trying to force the price to validate your ego. The market does not care about your ego. It only cares about absorption and supply. Wyckoff gave us a blueprint for institutional action. He showed us how the composite man operates, methodically, patiently, without emotion. When you see an accumulation schematic, you are seeing a massive, patient transfer of shares. Do you mimic that patience? Or do you jump in early, impatient for the immediate reward? Your psychological structure must mirror the market structure you are attempting to trade. If the market is in phase D, transitioning to phase E, your mindset must transition from skepticism to confident execution. This is where the synthesis happens. The chart becomes a mirror. The noise you experience is not the market's noise. It is the projection of your own internal chaos onto the price action. It is all you. You are not fighting the market. You are fighting your own impatience, your own need for validation, your own deeply ingrained fear of being wrong. The final test is simple. When the market executes the schematic exactly as Wyckoff described it, after the spring, after the test, after the final sign of strength, will you trust the structure you spent months analyzing? Or will you listen to the sudden loud voice of fear telling you it's too late or it's too high? Will you succumb to the emotional noise that seeks to sabotage your methodical edge? This is the chasm between the profitable and the perpetually stuck. The market is constant. The laws of supply and demand are unchanging. The schematics repeat themselves across every time frame and every asset. If the structure is constant and your results are inconsistent, then the variable making success impossible is not the chart. It is you. The market never changes its nature. It just exposes yours. The solution, then, is not in finding a better indicator, but in neutralizing that psychological variable. But how do you neutralize yourself without losing the intuition that makes you a trader? You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy and theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So, if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.